Welcome back. Now, a gold price boom and disciplined capital allocation have offset the impact of heavy rains and lower grades on DRDGold's operational performance. The miner has doubled its final dividend, benefiting from an increase in the average rand gold price. CEO Niël Pretorius joins us now for more on that performance. Thank you so much for your time, Niël. Let's actually start off with really what has been one of the most topical things that we've been following, and that is, of course, the high tide that lifted all boats, and that is the gold price. How much spark has that given DRDGold?
Oh, huge. The fact is our production was pretty much flat year on year. Last year we produced just over 5 tons of gold. This year we came in just a little bit below 5 tons of gold. Obviously we managed to contain our costs really well, and the fact that our 60 megawatt solar farm came into production helped us to sort of moderate the inflationary pressures that are typical of our industry. But the rest was all gold price. It was a phenomenal gold price here for us.
Well, I mean, just when you look at these kinds of price levels, then people start to look at your capital allocation, your investment decisions. And I'm wondering, I mean, with the gold price at these levels, could that incentivize DRDGold to commit to more investment in some areas?
Yeah. So we took a decision a few years back that the Ergo operations, which was our flagship operation, that we're not going to start decommissioning it, but that we're going to make the necessary investments to extend its life by another 20 years. And that was going to require the better part of 4 billion rand in capital. And a similar decision was taken, or in fact it was always envisaged that the Far West Gold operations in Carletonville, that the second phase, involving a doubling of the size of its plant and the construction of a whole new tailings storage facility, an 800-hectare facility that's fully lined with a similar outstanding capex bill, also of about 4 billion rand, that we would embark on that process. And that was on the basis of the gold price then, which all evidence had suggested at the time had decoupled from a number of other sort of global economic dynamics, and that it also rebased because of just a change in investment profiles, or let's call it accumulation patterns that we saw that started to emerge in jurisdictions that in the past didn't really have much of an impact on the gold price. So that decision was taken. What this has helped us now, the fact that we managed to generate 3.2 billion rand in cash flow from operations, is we're not having to borrow any money. We've got this wonderful facility, this 1.5 billion rand facility that we were going to start drawing down against. And instead of going into the red this year, and we'd anticipated that we'd be in the red to the tune of between 600 million and 950 million, we actually finished the year with 1.3 billion rand in the bank. So this is really helping us in this initiative to further extend the life of our operations and to continue to play the role that we are in this industry and also in the South African economy.
Yeah. Well, as you're talking about, those processes and projects that are underway at Ergo and also Far West, but also at the same time looking at the heavy rains, I do understand that production was not consistent throughout the year. How has that shaped up?
Yeah, well, we were pleased that we managed to actually come in at the level that we did, and that was because of a really good performance in the final quarter, the last 3 months. The rain really impacted us at Ergo, because Ergo is still, at this stage, a very complex operating footprint, or it has a very complex operating footprint. It's mining from 10 distinct sites, and accessing those with heavy machinery really becomes a problem when you've had 3-4 months of uninterrupted rain. So that impacted on the blend and then also on the throughput capacity of Ergo, where we've already throttled back on throughput because we're really nursing our tailings facility in anticipation of the new facilities that we're busy building and also lining up to resume deposition. The Aldagefontein tailings, we intend to resume deposition there from late next year.
Okay.
So that really impacted the ability to process and to maintain the right sort of blend into the plant. So yeah, to repeat what I said earlier, we were pleased that we actually came in at the level that we did. The last 3 months we thought was a good indicator of where we think we'll be going for the remainder of this interim phase through to financial 2028, when all of this capital reinvestment is taking place. And of course, then the objective is to go from 25 million tons per year of throughput to 36 million tons per year, and then to lift production from the roughly current 5 tons or just below 5 tons a year to north of 6 tons per year. And what really excites us is the fact that once we get to that point, so keep in mind that we're long capex, so you put up all of your infrastructure, and then beyond that point, you've got very little in terms of ongoing capital reinvestments, roughly between 5 and 10% of cash operating costs, maybe now a little bit less, considering where we are, that we will not be spending on average between 2 and 3 billion rand in reinvested capex. So we're looking at an interesting cash flow profile from financial year 28 onwards, assuming that the gold price will not weaken significantly.
Yeah. I just want to also drill into your cost profile, your operating cost profile. I do understand that you said that that is a priority at DRDGold to keep a lid on those costs. But there seems to be a general narrative across the mining industry of mining cost inflation. And I do obviously understand, because of the high gold price, it's not really going to do much on your margins. But just also with what you are busy with, for example, at Ergo, you talk about a complex operating profile. What then does that mean for your cost trajectory, at least in the short to medium term?
Look, the only reason why we were in a position to motivate a capex reinvestment program at Ergo with a view of extending its life of mine by to beyond 2040 was after we had, to a large extent, de-risked electricity supply and electricity costs, because we built this 60 megawatt solar farm or solar plant, and we coupled that to a 180 megawatt battery energy storage facility. So for the better part of 12 hours a day, Ergo is running on renewable energy. And we saw that impact already. It was only commissioned in November of last year, full commissioning, but we're already seeing that impact. And I think we recognize a saving of about 108 million rand for this financial year, for the 7 months of this financial year. So we're likely to see better savings in that regard. But that is obviously impacting the rand per ton cost profile. In modeling these businesses, in these projects, you're looking at your potential revenue per ton, and that you do on the basis of the gold content and an assumed recovery factor. And then you see, by adding up your various cost components, also on a per ton basis, whether you can maintain a cost per ton below the revenue line. And the solar farm is a big catalyst in that regard. Another equally big catalyst will be the reduction of the mechanical movement of material, or fewer sites, and more hydro mining with these high pressure hydro jets. So one man holding a hydro pressure jet moves a ton of material every 6 seconds. So that is an extremely efficient process, and it's cost efficient as well. And then those two components will further contribute. What we saw this year is that the complexity of the footprint notwithstanding, is Ergo managed to bring its cost per ton down from just over 205 rand or 250 rand a ton, if I'm not mistaken, to 191 rand per ton. Producing less gold because it's a slightly lower gold content, but that's how you sort of reposition and redesign the entire revenue cost construct. And that's what's taking Ergo into the future. That's the basis on which we could motivate this and hope to succeed in executing as well.
All right. Well, we have about a minute left, Niël. And as you talk about the future, now as you are in a new financial year, what are you holding on to? I mean, how would you describe your outlook? I get from the gold price it would be optimism, but would there be a cautious pretext to that?
Look, you obviously need to make sure that you keep everything together production-wise while you're in this. You become so focused and fixated on your capital projects, which are complex projects. They cost a lot of money. You are dedicating a lot of resources to make sure that they get done well. But in the meantime, you need to continue producing. So that is a big focal point for us. So we really want to make sure that we look after our infrastructure, that we maintain the necessary safety factors, that we do what we need to do in order to make sure that we can continue to produce uninterrupted at the current throughput levels of 25 million tons per year until we hit that. And it's going to be a systematic introduction to get us to the volume profile that we envisage for Vision 2028. So it's very, very sharp focus on both the operational aspect as well as the project execution aspect for the foreseeable future.
All right. Well, we do have to wrap up the conversation there, but thank you so much, as always, for your time and for your insights there, Niël. Really appreciate it. That was Niël Pretorius, CEO of DRDGold.